Hi folks. As we speed toward the end of the year, there are a few financial ideas that come to mind to make sure you're getting all you can out of this year. Now, most likely you'll be enrolling or reaffirming your annual benefits through your employer. If self-employed, you may be sitting down with a tax professional to review your year and discuss any tax implications. Additionally, this also tends to be the time, whether self-employed or not, that people review their various insurance plans. As I mentioned in my last video, double-checking your beneficiaries on your benefits is always a good idea. But there are several other good ideas to review before we run out of the days this year. Number 1, did you complete a Roth IRA conversion? Should you be completing a Roth IRA conversion this year? Now, several factors go into the conversation, including what your total earned income, any losses, tax filing status, and future tax outlook, to name a few. You'll most likely to want to work with an accountant and financial advisor or planner to determine the appropriate actions for your plans. The deadline for doing any conversions this year is December 31st. Number 2, the second one is a tough one here because it means either your spouse passed away or you went through a divorce this year. Now, changing your tax status for future years from married filing jointly to an individual filer, for example, could mean a whole lot of tax bracket jumps for you in future years. If you are able to realize some of your income or conversions from your investment or IRA accounts this year and still filed as married filing jointly, this could mean offsetting future taxes at a higher marginal bracket. It's often not something that most people think to look at, but could mean significant tax savings for the right individuals. Number 3, has your income increased this year? If so, consider increasing your savings rates on your investment accounts. This could mean while you might be double checking your beneficiaries on your 401k, that while you're logged into your plan online, that you also increase your deferral rate as well. That is, if you're not already capped by the contribution limit. Now, many people with increased inflation putting upward pressure on their employers to raise wages haven't carried those wage increases over to their personal savings plans. If you can't put more away into your company plan, consider increasing personal savings plans towards self-directed options that complement your current investments. Number 4, required minimum distributions. When it comes to RMDs, many people wait until year-end to take these. These distributions might be because you reached age 72 and are required to start taking the minimum out. Or you inherited an IRA or 401k from someone and must do so because of that inheritance. Now, don't forget to take your RMD. The penalty for missing this is 50% of the amount not taken. Alternatively, the end of the year spans the major holiday season in the U.S., which is often coupled with giving and being charitable. If you are required to take a distribution from your accounts due to an RMD requirement, you could elect to instead make a QCD, which stands for Qualified Charitable Distribution. The funds must be transferred directly to the charity for them to not count as income on your taxes. This doesn't allow you to make a deduction for the amount that was transferred to charity through this QCD, but it does avoid the income tax associated with taking the RMD normally. Number 5, health savings accounts. I'm still very surprised the amount of people that don't have a health savings account, even though they're eligible. A health savings account allows you to set aside money on a pre-tax basis to pay for qualified medical expenses. This means a tax deduction for any contributions you make this year in 2022, up to the $3,650 for individuals and $7,300 for a family. Now, in order to be eligible for an HSA, you must be enrolled in a high-deductible health plan that generally only covers preventative services before the deductible. For 2022, the minimum deductible for a high-deductible plan is $1,400 for individuals and $2,800 for a family. Now, these HSAs also don't need to be associated with your group health insurance plan, as many group plans don't always offer them along with the high-deductible insurance offering. The good news is that these accounts are easy to open and many banks are online through investment brokerages. And the funds inside your HSA can also be invested in market funds, which, although carry investment or market risk, have the potential for greater returns. Like most stuff on this list, there's a deadline of December 31st to make your yearly contribution. So there you have it, 5 ideas to help you make the most of the current year. Now this list is nowhere near exhaustive, but it covers most of the often discussed ideas I have with my clients. And maybe there's a few ideas to help you prepare to make the most of your finances before year end. If you found this insightful, please share with someone you care about and hit the button below before you go. As always, keep doing life better.